So what you look like, and I think we've changed a couple of the stuff. You have your collateral tokens, and they are based on all sorts of stuff. And there's more of a role for other stablecoins than I previously thought, but they rely again on repo, USD Treasury, and all of that. And stop me at any point that I'm talking nonsense. And then you have your reserve tokens, which are very liquid claims on these collateral tokens, and can be used as money. And I think they're also redeemable at any point if you want.
The reserve stablecoins are redeemable at any point.
Okay, excellent. Yeah. And then we haven't talked about those yet. Can you quickly, then you have reserve right tokens. And what my notes about these were is they can cover losses of specific reserve tokens. But this is on a somewhat voluntary basis. And they then can earn a fee for that. Is that a correct description?
Yes.
Okay, great. Now, on the right side, you see what I typically study. And this is a very liquid market-based bank. And they typically hold the super liquid stuff like repo, USD treasuries, also money market mutual fund shares, which are extremely liquid. And they hold deposits, which are claims on stuff on the asset side, but in a very short-term way. And equity serves to cover the loss, any losses on assets, because then deposits won't have to bear them. And in exchange, equity earns, a profit. So this is extremely similar, right? I'm not saying it's the same, but is that a fair comparison?
Yeah, I think it is a fair comparison. And as you pointed out, there's the slight difference of the reserve rights token holder having to choose to essentially provide that insurance function in exchange for the fees for any given stable coin, rather than just being in that position by default. But it seems like that's the main difference.
Yeah, and also I think, if I understood it correctly, a big difference is that reserve tokens are claims on very specific parts of the asset side, whereas deposits are sort of a broad claim on all assets. Is that also correct?
Well, let's see. What do you mean? So in the case of the normal bank deposits, what do you mean about them being a broad claim?
Well, okay, maybe I'm missing a deposit is like, in a way, every liability is a claim on the asset side of an institution, of a bank. But a deposit is specifically a claim on money deposited. And the idea is that the bank can sell these assets, preferably one-to-one with dollars, and get back those deposits. But a deposit is not tied to any specific instrument, like one repo contract or one treasury.
Right.
Whereas your reserve tokens, that's the impression I got, are tied to their own little specific collateral tokens.
Yeah, that's right. And so it's not that, like, once you've deposited the collateral is fungible, can be redeemed by somebody else. But it's you and that's why I compared it to an ETF. It's because to mint the token, you have to deposit exactly the entire basket. And then when you redeem the token, you also get exactly the entire basket.
Okay. So you do have to, So that I didn't get from your white paper. So you have to deposit the entire basket here, because I was wondering if it's different, then the reserve tokens might trade at slightly different prices, but that's not the case because it's the exact basket, correct?
Right, and so that makes issuance and redemption pretty inconvenient. And like I said before, it's not really something that a normal end user would do. It's more what a market maker or liquidity provider would be likely to do, because it is pretty inconvenient.
Yeah. And then if this analysis is correct, so I would like to have your opinion on something that stood out to me as a somewhat ironic way of state of crypto, in the sense that, and now we're getting back to this, crypto has a very strong commodity money culture. that frowns upon private money creation. But what you're doing is pure private money creation in the same way that banks do it, right? Like your reserve tokens are extremely similar to private deposit creation. Is that correct? And do you also see the irony? I'm not saying that this is you're inconsistent in this, but do you see sort of what I mean?
I think I see what you mean, but I want to make sure. Like, I think I can maybe learn a little bit from you right now. So when you talk about private money creation, do you specifically mean the sort of like expansion of the money supply in some sense from the lending that happens, or are you saying that money creation occurs even like without lending happening? Just by somehow just if you're depositing, money into like a full reserve bank that doesn't lend it out or something.
Yeah. So that's a good question. Like if in a banking case, like sort of how I describe money creation in the most simple example, it would be that a loan is given out to a customer, and that customer receives new deposits for that. So that is really clear and pure money creation.
Right.
But something that's very close to it is that the government would issue debt, and that the bank is the buyer, and how the bank then purchases this is with newly created deposits. I think as you can see that is extremely similar. Another way to look at this is that the bank, because so in one of my videos, how credit money transformed medieval Europe, I think it was, I made the case that you can also look at this as the bank monetizes the debt of the government. The government creates debt, and the bank monetizes it. And that brings us to, I think, another irony of your stage one in your project. That is that you, because you're indirectly also have US treasuries on your balance sheet, you don't have it, but indirectly, right? And with your reserve tokens being money, you are also monetizing US government debt.
Yep. So I would say that in the case of the, you talked about sort of the two different reserve tokens. There's the one that's backed directly by US dollar stablecoins, and then there's the one that's backed by these, compound or Aave tokens. For the first one, the thing that's happening within the reserve protocol itself, I think, doesn't include any, money creation. Whereas in the second one, I guess technically within our smart contract, there's still not money creation, but because of the fact that those stable coins are getting lent out through a compound, like money creation is happening there because, you have the person who deposited them into compound who, has a balance, and then you have the person who borrowed those coins sort of now has a balance. And so you are getting basically the same pattern of, the expansion of, how many units of currency people feel like they have through that system. And then for the first stablecoin, it's still the case that there's these underlying US dollar balances in the banking system that, as you said, are maybe being held by the bank in the form of treasuries or something else. So yeah, I mean, really, I think what you're pointing at is accurate. So yeah, so it really is the case that what we're doing now is just making, essentially existing US dollar, balances and transactions available to people in parts of the world that, especially want them and especially have trouble getting them. It's really no innovation in like the nature of money or currency or even like, how these balances really work. I mean, it's just a different sort of technological delivery method, and it does have to do with, what is regulatorily feasible to offer to these people. And then in the future, then we do start to get into something that's interesting and different that uses the same protocol. But yeah, for now, we really aren't doing anything innovative when it comes to like how money works.